Let's look at capital payables. Now, when you first bring your historical capital payables balances into your financial model from your accounting package, they're brought into your historical balance sheet. Your capital payables balances are below your inventory payables within the current liability section. You can see in this example, we have one category titled capital payables, and we have the historical balance on the right-hand side of the sheet. If we were to scroll across our time series until our closing historical month of June 22, we can see that we have a closing balance of 8.3 for our one category of capital payables. When we forecast capital payables, this is handled on our working capital sheet. And on the sheet, this is located at the bottom underneath our inventory payables analysis. Looking at our analysis, we can see our one category of capital payables being pulled through, as well as our opening balance of 8.3 coming from our historical balance sheet. Now, you'll notice that at the top of this analysis, we're pulling in our capital expenditure forecasts, inclusive of GST. Now, as with our other areas of working capital analysis, there are a few moving parts, so it's easiest if I wipe this down to zero before stepping through the different aspects. Now that this is wiped down to zero, you can see that we have no capital expenditure flowing through our analysis, and our opening balance of 8.3 is not received throughout the model. Now, our first assumption here in column I is the period over which we assume we're going to pay off our opening capital payables balance of 8.3. If we assume that we're going to pay off this opening balance over a period of 30 days, once we enter our assumption of 30 days, you can see that the entire balance is paid off within our first forecast month of July 22. If we assume we were going to pay this over a longer duration of time, say for example 45 days, when we increase our assumption to 45 days, you'll see that our cash payments are now spread across July and August. The way that this is calculated is we assume that the opening balance, currently at 8.3, is divided into 45 equal payments spread across a 45-day period. As we have 31 days in July, we would have 31 of those payments occurring in July, with the remaining 14 payments taking place within August. And this is what drives the difference in payments between the 2 months. As there are 31 months in both days, if we wanted to spread it evenly across these, we could update our assumption to say 62 days, and then you can see that we have even payments occurring between July and August of 4.1. So now let's look at how we forecast our capital payables balance in relation to our forecast capital expenditures. To start, I'm going to allocate our land capital expenditure back into our capital payables analysis so that we have forecast numbers to work with. Now, in our analysis, we're currently using a cash payment delay mechanic, and this is similar to how we forecast our creditors analysis. So within a monthly model, we use our cash payment delay mechanic, and if you want to recap as to why we use a cash payment delay mechanic as opposed to a days term mechanic, then I suggest you go and watch our creditors video for a quick recap. Now, if we look at December 22 as an example, you can see that we have our 11.0 of capital expenditure forecasts coming from our allocation at the top of the analysis. It's currently being paid in cash in the same month as our cash payment delay is set to 0. The way that our cash payment delay works is we assume that all capital expenditure is spread evenly throughout a period, and we receive invoices throughout the period. For example, with our 11.0, the 11.0 would be spread across 31 invoices across the month of December, with the first invoice being received on December 1st, and so on. After a certain number of days, our cash payment delay assumption, each invoice is then paid. For example, if we assumed a 31-day delay for the month of December 22, when I enter our assumption, we'll see that our entire balance is then paid off in January 2023. This is the first invoice that was received on December 1st is paid 31 days later on the 1st of January. The invoice received on the 2nd of December is then paid 31 days later on the 2nd of January, and so on. If we assume that we were going to pay over a longer duration, for example 45 days, again when we update our assumption, you will then see that the cash payments are spread across January and February. Now, operating off a 45-day delay, the invoice received on December 1st would now be paid off in January the 15th, and the second invoice being paid on January 16th, and so on. If we applied our 45-day delay assumption to our entire analysis, you'll see that this then comes to life, as we're now using a consistent forecast assumption for our capital payables analysis. When we look at the financial statement impacts of capital payables within a three-way financial model, if we assume that we had $100 of capital expenditure in a given period, if we had only paid half of this balance to our suppliers, and we still had half outstanding, we would then adjust for this with an increase in our capital payables balance within the current liability section of our balance sheet. This is matched with an increase within the investing section of our cash flow statement. If we look solely at the impacts of capital payables alone, you can see that this is an increase in our investing cash flows, increasing our change in cash held, and increasing our cash at bank. This increase in total asset is matched with an increase in our current liabilities, increasing our total liabilities, and therefore we have no change to our net assets and our balance sheet balances. Hopping back to our example, we can see that we have an increase of 11.0 in the December 22 month to our capital payables balance. If we wanted to see the movement in this balance on our financial statements, we can then head to our table of contents and then activate our financial statements. Heading first to our balance sheet, if we expand our accounts payable collapse rows, we can see our capital payables category, and if we scroll across the time series until our forecast month of December 22, we can then see our balance of 11.0 in our current liabilities on the balance sheet. Similarly, if we then scroll down to our cash flow statement, in the month of December 22, we can then see our 11.0 increase in our capital payables on the cash flow statement within our investing section. When looking at the financial statement impacts of capital payables within a three-way financial model, it's important to note that this is simply an adjustment to the balance sheet and the cash flow statement, and does not affect the profitability of a business. Our increase in capital payables is an adjustment to the current liability section of our balance sheet, which is matched with an adjustment to our investing cash flows. These adjustments ensure that our net assets remain unchanged and our balance sheet balances.